Hi everyone, and thanks for logging in to join us for this Australia-UK Chamber webinar, which launches our Capital 2020 series with this session on the future of capital raising and venture investment. I'm Catherine, Chief Executive of the Chamber, and really pleased to have you all with us today. We're so excited about the launch of this series and this webinar, focusing on the evolving trends in how investors and raising companies are making decisions, how COVID-19 is disrupting or accelerating those trends, and what that means for those of you that are seeking to invest or seeking to raise in the next few months. We've got a stellar lineup with us today to discuss this, including Faes, Executive Chairman of LendInvest, Jonno Elliot, Managing Director for Virgin Management, James Clark, Marketing Director for Draper, Esprit, Nalin Patel, Capital Analyst for Pitchbook, and Steve Torso, Managing Director for Wholesale Investor. Thank you so much to each of our speakers for joining us for what promises to be a really good session. Speaking of Steve Torso, we're delighted to be delivering this webinar in partnership, and indeed the entire Capital 2020 series in partnership with Wholesale Investor, Australasia's leading private investment platform connecting companies with investors and operating an investment deal room online. A hugely relevant and valuable tool, particularly as an increasing portion of our activities move online. A big thanks to Steve and his team, including Lee Harrison, for their collaboration on this series, which we dreamed up with them a few months ago and are delighted to be launching today. This webinar is also supported by our member, the Western Australian Government here in London, who have a fantastic innovation and ecosystem driven by both their state government and local industry. So if you're a British fan looking at Australian opportunities, then I do encourage you to have a chat with Mike Deeks and his team at the Western Australian Government Office in London, and we'll share his details shortly. A few notes on running order. We're first going to hear a few remarks from Steve on how Wholesale Investor sees the future of capital, particularly from an Australian perspective. And we're then going to hear from our panel in London, chaired by Faes. As ever, we'll have time for audience Q&A, which is always a fantastic part of the session. So please do share your thoughts and questions in the Q&A box at the bottom of your screen for Christian to field these to our panelists. I'm now very pleased to pass the screen to Steve at Wholesale Investor to kick off the session. Thank you so much, Steve.
Thank you very much, Catherine. Okay, now just going to bring up my presentation. So as Catherine mentioned, I'm going to be talking about the way we see the future of capital raising. And to give you some context, Wholesale Investor, we've been working with companies, basically private pre-IPO and small cap companies now for the last 11 years. And in that time, I've worked with over 1,500 different companies, and we've been promoting them to over 29,300 high net worth professional and international investors, mostly across Australia, ASEAN, and also the UK. And one of the interesting things is when we're working with investors, one of the common comment that investors typically have for us is, Steve, can you please introduce me to the good deals? Well, the challenge is that everyone has their own version of what is good or not. And in this sort of presentation, I'm going to try and summarize everything as simply as possible as for what are the frustrations and what is the opportunity. For investors, what it comes down to the core elements that they're looking for going forward is they want access to opportunities. They want deals which are relevant to either their existing portfolio of companies or relevant to the sectors which are of interest to them. They want to have a streamlined and standardized process because at the moment it's coming from all sorts of different directions. But last one is they want to have speed to a decision, right? So instead of spending 6 months looking at an opportunity, they want to be able to make a fast decision when they're going through that process. When we're working with companies, often the question is, can you please introduce me to the good investors? Well, you can do that, but the challenge is that investor going to be interested? And it goes back to that relevancy equation that I was mentioning before. And if you look at how this sort of frustration was created, it goes back to sort of the history of capital raising in that it's sort of been considered mostly a bit of a dark art, and it's typically centralized around personal networks. And in this case, whether it be corporate finance, professional services, or advisors are typically looking to take a 6 to 8% success fee along with their typical sort of mandate fee. And the only way that's really changed over the last 100 plus years is really the addition of email and Excel spreadsheet. If you look at capital raising 2.0, it recognizes the potential of the internet, but those platforms have then decided we want to take on the model of the corporate advisors where they're trying to charge success fees for that sort of online introduction. Whilst it does also use other services like virtual data rooms and so forth, the challenge is you're basically left with a fragmented ecosystem, manual processes, isolated solutions, a lack of investor connectivity or pressure on opportunities, and lastly, no investor analytics, right? And from the company side, they spend a lot of time and a lot of frustration trying to get access and trying to discover investors, but really there's just a whole lot of money and time wasted in the actual process. So the way we see is capital raising 3.0 lends into subscription-based deal making and investor aggregation. So if you can think about how they can utilize basically the innovations at which it's been investing to over the last few years, it effectively looks for AI to provide matchmaking, frictionless engagement, efficient transactions, digital investment banking tools for most companies, but most importantly, the actual creation of more opportunities and the breaking down of borders. And the real skill from the advisory side is really more in the sort of deal creation and the deal structuring side. So the way we see it is that when we look at what the future of capital raising is, we think about it from the point of view of it's obviously software driven, it's ecosystem enabled, it's an end-to-end solution, investors obviously provided, and the matchmaking is done via machine learning. But most importantly, there's analytics provided before, during, and after the transaction as to what's successful and what not. Right. So, but really the outcome is improved efficiency, faster decision times, but streamlined processes for all involved. And if you think about what digital investment banking could look like, is what it typically provides then is access for the investment bankers for the companies from an integrated online platform to have access to SME debt, to have access to the ability to syndicate their investment opportunities, to actually provide book builds with their own, whether it be listed companies or private companies, be able to do book builds for their capital raising. It allows for that investor matchmaking, but the other part, the most important part is it can provide a mechanism to provide liquidity via secondary sales. So you can see the outcome is really about that efficiency and then the creation of opportunities. In this example, what we provide you is what the deal intelligence looked like. And effectively, this is a bit of an insight into my own deal room. You can see that from this, right, when you're a private company going to a capital raising, often you don't know what's of interest to the investors. Whereas a little bit of intelligence provides you with an understanding. And those numbers down the left-hand side really highlight what is of interest to investors when they're actually looking at my opportunity. That provides me with some sort of intelligence and some sort of insight. And then if an investor wants to go and make a share application, they can simply just choose the account they want to make the application and it's completely filled for them. Now, whilst there's a whole lot more to it, there's just two simple ways in which you can actually streamline the process. But really the way we're thinking about it is the summary of the future of venture investment and actually capital raising is, once again, subscription-based deal making and investor aggregation. So it can learn off the technology it's been funding for the last decade and utilize that to provide efficiency, to provide relevancy, to provide trust loops, but more than that, to be able to create more opportunities and break down borders in the existing ecosystem. For us, we see that as one of the most powerful ways for both the companies that are raising money and for investors to become more aligned in their actual deal making. I've put my details here. I often like to sort of provide information, education around the capital raising area. And of course, we run our own sort of showcase events as well. You can add me on LinkedIn. That's my email address. And our website is CRIISP.io. I'd like to say thank you to Catherine and the Australian UK Chamber team. You guys have been phenomenal to work with and much appreciated, and look forward to the panel session.
Thanks so much, Steve. We're now going to get started with our panel session. So I'd now like to invite Christian Faes, our moderator, to the screen. Joining him as panelists will be James Clark of Draper Esprit. Welcome, Christian and James. Nalin Patel of Pitchbook, and Jonno of Virgin Management. Welcome, Nalin and Jonno. And Christian, with that, I hand it over to you.
Brilliant. Thank you very much, Catherine, and good morning to everyone. Well, I guess good morning if you're in London, and good afternoon if you're joining from Australia. It's great to have the opportunity to moderate today's panel. We've got a really interesting group of people together, and I'm very keen to hear their views on things. Just quick introduction, I guess, from myself. So I'm Christian Faes, co-founder and now exec chair of a mortgage lending platform that I set up here in the UK 12 years ago. But I am very much an Aussie, and over the last 12 years have raised a lot of capital for our business. But I'm keen to hear the views from the panelists. So with that, I'd ask we just do a quick round of intros, just 30 seconds, just to hear from everyone, and then we'll get straight into the discussion. So perhaps, James, we'll start with yourself.
Yeah, hi there. My name is James Clark. I'm also Australian. I moved here about, actually 15 years ago. I'm marketing director at Draper Esprit. It's a pan-European publicly listed VC fund. So we invest into Series A companies and above. So typically checks of 5 to 10 million and up for new investments. But we are publicly listed, so you can buy shares in us on London Stock Exchange or Euronext Dublin.
Great. Nalin?
Yeah, hi, I'm Nalin Patel. I'm a private capital analyst with Pitchbook in London, covering venture capital and technology markets. Pitchbook is a financial technology company that provides data on private capital markets to help to identify opportunities for investors and professionals. We provide data alongside analysis through our Pitchbook platform and in-depth equity research reports. Prior to Pitchbook, I was at Goldman Sachs for just over 3 years.
Great. And finally, Jonno.
Hey, thanks for having us, Catherine and the team. My name is Jonno Elliot. I'm a managing director on the investment team at Virgin Management. This is the Branson's family office. We're a long-term focused investor, and our team's role is to manage all of the family's investments across strategy, stage, and sector. My particular focus over the last 9 years that I've been with the group has been to build out a strategy and portfolio of what I would call early growth stage investments. They've been predominantly in direct venture capital. We do have some fund exposure, but with a very specific purpose behind that. And some of our investments that you may know would be companies like TransferWise, Slack, Ring, Twitter, Square, etc. But happy to be here and look forward to the panel. Thank you.
Great. Yeah, thanks, guys. So maybe we'll get straight into the discussion. And I was keen to, and I guess it's a question for all of the panelists, but Nalin, we'll start with yourself. And want to start with the discussion around the boom in private markets. And I guess it feels like over the last sort of 5 to 10 years, there's been a bit of a boom in private market fundraising, and increasingly in the last couple of years, I guess, new types of investors coming into the market. So it's not just VCs now. You've got private equity investors, family offices, large institutions are increasingly sort of keen to get direct investment, it seems, into these private market opportunities. I mean, from PitchBook's perspective, what's the sort of data show on that, and what do you clearly you would be seeing that, and what's your sort of view on that?
Yeah, I mean, competition has been increasing. There's no doubt about that. From the deals we've been seeing, there's been a broadening of participants from new and international investors, as well as non-traditional sources. So a lot more outward and inward investment into Europe and the US from other continents. In Europe, for example, approximately 75% of deal value in 2019 had some form of non-traditional participation. So that could be either from a sovereign wealth fund, a CVC arm, a pension fund, private equity house. And overall, the quantity and value of those deals that have had a portion of non-traditional investment has been increasing over the last decade. At the start of the decade, it was around about 5 billion. And last year, in total, it was about 32 billion. And 75% of that has some sort of non-traditional aspect to it. And also, we're seeing a broadening of the types of non-traditional investors that are investing in deals as well. We've had a real emergence of wealthy tech entrepreneurs, such as Jeff Bezos, Bill Gates. They've now got their own capital VC arms, and they've been investing heavily, as well as tech corporates as well, founding, carving out their particular arms and putting capital to work, which has really kind of inflated valuations and round sizes across the board. Looking ahead, forward ahead, because of COVID-19, we anticipate it may kind of taper, but the growth has really been there over the last decade, and it has really shown a lot of strength. Also, we have seen a bit more of startups and actual private companies investing in other startups as well. For example, Revolut, they raised a round this year, in Europe, and because of COVID-19, they're now looking to invest in rival challenger fintech companies with that round rather than expand into the US. And I think that the final thing I want to touch on is probably the fear of missing out is a big factor for these investors. And they have been competing to get on deals with VC investors as well. And as a result, VC fund managers have also been increasing their fund sizes. As a result, this is permeated with founder friendliness and larger rounds, causing a general maturation of the ecosystem globally. And we think there could be a significant shift in negotiating dynamics towards investors now as we kind of enter this new economic cycle, as it's kind of shifted towards startups recently.
Great. Thanks, Nalin. Yeah, there's a couple of interesting points there. I guess increasingly competition from overseas as well. You see in Europe, certainly US investors getting a bit more aggressive over here. I mean, James, is the VC on the panel, representative of your Patagonia vest. We know, we know the VC is. But from a VC's perspective, what's your sort of view on this? I mean, do you guys sort of see this as competition, this sort of increased interest in private markets, or is there a way to collaborate with these types of investors, or what sort of perspective do you guys have on things?
So Draper has a peculiar sort of place to play in all of this because we're publicly listed. We listed in 2016, and in a previous life before I started Draper Esprit, I worked at London Stock Exchange, and I actually hosted Draper Esprit when they rang the bell in London. So there's a sort of circle of life thing going on there. But the interesting thing for us, and sort of putting my old stock exchange hat on, was at last time I was there, there's like 350, 400 billion pounds worth of capital under management just dedicated towards London listed equities. And so you'll have these asset managers and pension funds and whoever else who want to get into private investment, but wouldn't have an investment mandate to be able to do so. So part of the reason why Draper Esprit listed was we effectively became a bridge to those asset managers to be able to invest into the best early stage tech companies, but who don't have a mandate to do so. So we've noticed this big shift into private markets over the last sort of half decade or so. And I think that, you've seen a lot more funds being created. You've seen a lot more funds being raised. You've seen existing funds are out there raising ever bigger funds. So definitely there's more money in the market, but there's still a lot more money to be able to be tapped. And so I guess what we see is, there's definite interest in these businesses. Companies like TransferWise and Revolut that have already been mentioned, these are sort of ever bigger European companies, and they're companies that we've invested in, but there's a maturation about how the market is seeing these. So Draper Esprit has done secondary deals with buying sort of seed funds wholesale. So that allows the companies that the assets they invest in to stay private longer, because we join the board and we have a similar time horizon to their later stage investors. We also have a fund-of-funds segment, which are now a fund-of-funds offer, which means that we're investing into a dozen or so seed funds across Europe as an LP. It's a very exciting time because there's this maturation, means there's lots of different investment models being deployed. And that means that different things can be tried across Europe. And that's a very exciting time to be part of that.
Interesting. And Jonno, from Virgin's perspective, I mean, I guess I wouldn't naturally think of Virgin as sort of a venture investor, but then, some of the names you've mentioned that you've been able to get into in terms of deals, you clearly have access to great deal flow. I mean, how does Virgin view this type of investment opportunity? And is it a sort of a corporate, investor perspective where you're looking for synergies with the wider Virgin brand, or is it more of a, an economic return that you're looking for?
Sure. I think, thanks, Chris. And just before answering that, I think what's also important for folks to understand is, as Nalin and James have said, we've clearly seen more capital come into the ecosystem. The empirical data shows that. But I think you also got to look at why. I think the reason we've seen capital come in, because the data also shows that companies are staying private for longer. That's probably chicken and egg, because there's more sources of capital available. You can delay sort of tapping the public markets. And what that meant is, again, linked to that is that because companies are staying private longer, you can no longer achieve the types of returns you could by investing in them for the first time when they go public. And so we've seen investors need to access private markets, predominantly through venture and various stages of funds, but the need to invest earlier to still see these sorts of venture-like returns. So if you invested in Amazon when it went public, you could have still made 100 times your money. if you invested in Facebook, for example, when it went public, you would have made 5 times your money by now. And so in order to tap these venture returns, people are investing earlier. And I think that's also driven by the fact that we've seen software companies or internet companies become the most dominant and largest companies in the world. We've all seen that chart a decade ago. A decade ago, you know, there were a couple of tech companies in the top 10 by market cap. Now the top 5 in the world are all tech companies. But from Virgin's perspective, we do this actually more from a returns perspective than a typical corporate VC perspective. And what I mean by that is these decisions are made at Virgin Management. We're investing in these entrepreneurs because we think they're building something that is truly game-changing. But we don't let the potential for these companies in our venture portfolio to you know, have some sort of partnership or relationship with one of the Virgin companies. That's not a criteria for investment. So while the ecosystem's matured, like everyone has said, and I think that's great for entrepreneurs. We've seen, you know, fairly well established the data. I'm sure Nalin could quote this, but there's sort of a very healthy seed and angel ecosystem of top, you know, second-time entrepreneurs who are now investing back in Europe in startups. We've got a very healthy cadre of Series A funds. These are sort of the areas I'd break it into: seed and angel. Series A, you've then got your B and C opportunities, and then the growth investors after that. And so the only caution I would say for entrepreneurs is that while there's so much more capital available, I think it's the decision of who to choose as your investment partner has never been more important, or perhaps more clouded. You're seeing single, you know, family offices join this. They're trying to get into an SPV in the, you know, in a pre-IPO round, but they're coming in as a sort of once-off investment versus building a long-term portfolio, which is what we've taken. So I'm not saying you shouldn't be taking family office money. Please do, because that's where we invest. But I think you should be very clear on what the objectives and how long-term focused the capital that you're taking on. The simple test that I make from an investor side, which I think entrepreneurs should do the same, is you are literally making a decision. I ask myself whether I want to interact with or speak to this person or this team of folks every month for the next 10 years. That should be the test. And if the answer is no, then you do not want to get into a situation for either side where you have disengaged partners. I think that's lose-lose. So you've got to be cautious about the capital that you take, but there's certainly the positives are that you've got a very mature ecosystem, well-defined roles and stages where people are acting. And by my count, there's probably about 1,000 plus, that's just a number I do at the top of my back of the envelope, probably 1,000 plus folks now in 2020 whose livelihoods depend on the success of the European VC ecosystem across those various funds. And that's a healthy place to be. It's still small relative to other global tech ecosystems. But I think when I look back to, you know, 9, 10 years ago when I started in this space, we certainly just didn't have that depth of capital and or infrastructure and ecosystem support.
Yeah, no, that's really good. And I think it's a great point to mention about sort of referencing your investors. And I guess from those that are raising capital, it becomes even more complicated market with sort of new players coming into the realm. I would encourage, if anyone in the audience has questions, please use the chat function in Zoom. We're going to go to audience questions shortly. But I want to talk about, we're talking about companies staying private for longer and talk about exits, I guess. You know, we've seen some big exits over the last few years, but also, I guess, last year, some challenged exits when we talk about IPOs. And James, you mentioned before, I know you're back from the LSE days. I mean, I guess if you put your London Stock Exchange hat on or use your experience there, I mean, do you think that is right, that the IPO is becoming increasingly challenged as an exit strategy for companies? I mean, last year we saw, you know, so Uber, Lyft, I mean, Slack, John, I mean, it kind of had a bit of a rough start. I see that the share price is right back up there now. So it's a good result. But companies like WeWork, I guess, didn't quite get there. I mean, and actually, correct me if I'm wrong, and I know that you will, I understand there's like less companies on the LSE now. as time goes on, companies being taken private than actually are going public. So is that kind of a trend that is concerning from a private market investor's perspective?
I think the thing to bear in mind is that, 20, 25 years ago, if you're raising, sort of trying to raise $100 million or more, or even $50 million or more, a public listing was the only game in town. I mean, if you look at, there's a documentary called General Magic, which is about the company that sort of invented the smartphone 15 years before Apple. They IPO'd on NASDAQ with no at concept stage, without a product, nothing, just at concept stage. And so, 25 years ago, the only way to raise capital, more or less, there was venture capital out there, but public markets were the easiest way to tap capital markets to raise capital to grow. And I think sort of what we've seen, especially over the last decade or 15 years, is as more private company money has gone into private markets, and Jonno was saying there's a bit of a chicken and egg aspect of this, more companies have stayed private because there's more money in private markets. And so if you look at it that way, there are more ways as a company you can raise capital now. And actually that's pretty healthy, because ultimately, and this is something I very much advocated while at the stock exchange, as a company, you should be raising capital the way that best suits your company. You shouldn't be raising capital from VCs because you think it's the right thing to do. You shouldn't be listing the company because somebody else told you to do so. You should be looking at the range of capital options you have available to you and raising capital in the way that is most suitable. And I mean, Christian, if you look at LendInvest, you guys have had the full checklist of different capital raising formats, whether that is a publicly listed bond, whether that's a securitization, whether it's debt finance, equity finance. There's so many options out there.
Haven't got the IPO yet, though.
Yeah, well, I missed out on that one. Nearly got there. But the thing is that I think this is a very healthy environment where companies can choose the most suitable capital format for them. So that's the first thing to say. The second thing to say is that, yeah, there is a bit of an interesting thing. As companies go private later or larger, they're sort of hitting a stall point as they hit the public markets. And if I look at sort of, WeWork didn't get there, and Uber almost, Uber struggled and whatever else. Historically, companies would have gone public where they were very much in the early ramp-up stage. So for the first few years as a public company, they saw the kind of growth that now gets accrued to private investors. And so what you're seeing is companies sort of getting to almost the stall point and then listing, which means that if something goes wrong, it happens very early in their public life. Whereas previously that was sort of happening 5 or 10 years into their public life. So there's an aspect of this, which is if you're a private company looking to tap the public markets, you need to make sure that you're tapping them at the right point, and that you can continue your upward trajectory, and you continue to manage the investors on the public markets, because they look at your growth very differently to a private investor. And so ultimately they're looking for consistency of performance. They're looking for you to know what your growth trajectory looks like, and they'll reward you for accuracy of growth, even if that growth isn't very high, rather than they'll probably punish you if you're inaccurate. If you're up a long way or down a long way, that's a sign to public market asset managers of, well, you don't understand your business. So the thing is, if you're making that move, is to really understand your next sort of 18 months as closely as you possibly can, and then deliver what you said you were going to deliver.
Yeah, I think that's an interesting point. I'll come back to that. Nalin, from Pitchbook's perspective, I mean, what does the data show on that? I mean, clearly you'd be seeing there's less IPOs happening, and I guess what flows from that.
Yeah, I mean, looking back to 2018 in terms of European-based IPOs, it was a record year. It was a bumpy year. Spotify, Adyen, Farfetch, Funding Circle, all listed. So everyone kind of thought that maybe actually there may be a shift in the ecosystem and kind of a viewpoint, but to echo what the guys have said, late stage capital has really revolutionized the ecosystem completely. Companies are staying longer, private for longer. They are able to seek capital within the private capital markets. And this has altered exit horizons drastically for investors and startups. And many more are now seeking out late stage rounds, which we define as Series C onwards, rather than exiting the ecosystem. We've got a lot of unicorns within the ecosystem as well now. Monzo, Deliveroo, companies like that, which would have traditionally, IPO'd or exited years ago. They've now got multi-billion euro valuations. And this isn't just a trend in VC, but the broader private capital markets, whereby the number of listed companies has fallen drastically over the years, and the number of institutionally backed PE companies, for example, has overtaken the number of listed companies globally. So I think that the access to capital within private capital markets has really driven that. But it's not just isolated to IPOs as well. This quarter, less than 1 billion was exited across Europe. So it's really a general trend across exits on the whole in terms of acquisitions as well as PE buyouts, where companies are staying longer and staying within the ecosystem to access that late stage capital that has been readily available for a number of years now.
Yeah, and just coming back to James's point about sort of the importance of hitting your metrics and your targets and things like that. I mean, I won't go on a rant about the cult of the unicorn and how helpful or unhelpful that's been. But Jonno, from an investor's perspective, it seems that some of these challenged, and we don't want to talk about WeWork or but where there's been perhaps challenged exits. Increasingly, it felt like last year there was a return to a focus on profitability. I mean, who would have thought? But more of a focus on can a business be profitable and can it have proper sort of unit economics? And that was perceived as being part of a contributor to sort of the trouble around exits. I mean, from an investor's perspective, how concerned about profitability are you when you look at these things?
Yeah. Look, I think that was perhaps the narrative in the media and for retail investors who were looking, as I said, to invest at the IPO and expecting this big run up. I think an investor's job is always to balance that fine line between profitability and growth. If you look at the data, though, what we've seen in the last 10 years, there's absolutely a case to be made that the category leader, the gap between the category leader in whichever sector we see and the rest of the competition, that is widening. And so the way you manage this, if you mentioned it, if you focus on unit economics, does this business make sense? Looking at the gross margins, let's take Slack, for example. It keeps getting beat up in the public markets, but it's got an almost 90% gross margin. There's almost zero churn from anyone who's ever paid money to use the product. And when you look at a business like that with a few competitors who've fallen by the wayside, we'll talk about teams in a second, but Atlassian, for example, was going head to head with HipChat. It made sense for them to keep raising money. Eventually, they actually sort of bought or merged with that business. But it makes all the sense in the world for Slack to raise money to invest in this product when we know it's got a very healthy growth margin, a fairly efficient sales cycle, put the money into sales and capture that market share. So, from the VC community's perspective, I think we've always been focused on unit economics. How does this business scale? What does it make sense? We're almost always investing ahead of demand, and we've got this J curve, which is fairly well understood. If you've got an idea that is the leader and it's something that will be disruptive, then it makes sense to invest in that. We're very seldom in the early stages of investing looking at profitable businesses. And to be honest, when someone sends us a pitch deck that's got a DCF on page 1 for, at the back of the presentation for a seed stage investment, the only thing I'm certain about that investment is that DCF is wrong. And so, yes, I'm not saying it should be growth at all costs, but if the fundamentals of that business make sense, I think it's shown, there's probably a lot of data to support that those category leaders, you should be investing money. Yes, the money's been thrown at them and we've invested more than we perhaps need. But I guess going into the type of environment we're seeing now, people are probably happy that they've got more cash on their balance sheet than they necessarily needed, because now's a pretty tough time to raise capital.
Yeah, no, good answer. I'm keen to take questions from the audience and to bring Steve actually back into the mix to help with some of these questions. So if we can get Steve unmuted and back on, that would be great. I think that there's some questions coming through on this as well, but keen to ask everyone in terms of what they think a post-COVID world looks like. And I guess, can you even transact now? I mean, is it possible to do a deal virtually? Because I understand that in the private markets, you are making a big investment in the team often, and you sort of, meeting them and looking them in the eye and sort of getting to know the people involved is often a key part of an investment. I mean, maybe Steve, will throw you straight into it. I mean, what are you guys seeing in terms of the ability to be able to transact in the current environment and how things might look moving forward?
So starting at a sector level, there's obviously been sectors that have sort of shined in this period, and there's also been sectors that have been really challenged. So if you look at sort of technology and sort of healthcare related businesses, they've still been receiving investment, they've still been announcing deals, and they're still seeing a whole lot of interest come in. I think platform-based businesses have done quite well in this period. The other thing you're starting to notice that a lot of the deal makers are sort of relying on their existing networks also to continue to create new opportunities. And they're effectively, you know, so I know from my perspective as well is the seamless use of technology, you know, has also sort of started to play more of a role in the deal making, in that in some cases there was no other choice. So for me, my hope going forward is that this starts to play more of a role in, because this market has suddenly become a lot more efficient in the communication and how many conversations you can have in a single day, from founder to investor.
And geographical reach as well, I presume. You know, people from
Correct.
Australia have access to the world. Do the others have views on that?
Sure.
Yeah.
You know, I don't think that the sort of physical distancing element of you know, the pandemic has affected the due diligence per se. You know, a lot of the DD we do is based on a belief in the founder. Yes, you need to meet them, but you can still, you know, meet them online. It's always been a healthy mix of online or in person. I think the part that is unclear to me yet, you know, we've probably made 75+% of our portfolio investments by value in North America. And I travel frequently, you know, probably once a quarter, I'm at least there in person on the East and West Coast. So it's probably 10 trips a year. To be see how that's affected. And where that affects us is a lot of this is about relationships. It's not so much the DD that you're doing in the moment. Most people have met companies a year or so before they're investing in them, or at least in our case, that's the case through your network and referrals and meeting people in person. So I do think you need to be out there and sharing and ideas and interacting with folks. But on the DD side specifically, we're not seeing an impact to our process necessarily from that.
Yeah,
James, you guys are still open for business?
Oh, very much so. I mean, I think there was sort of a couple of weeks, maybe up to a month, where everyone sort of paused and sort of tried to figure out how things were going to work now. But deals still happen. I mean, we had a follow-on deal in a company called Aircall. It was French. It was 2 weeks ago. We've got deals that continue to happen at the moment. I think it's a little bit tougher to originate brand new deals with companies. I mean, if you take this conversation here, if we were having this event in person at a physical location, following this event, there'll be a great chance to network and exchange business cards and source new deals and all that sort of stuff. So I think that there can be a bit of a challenge to make those first types of connections that lead to something further down the track. So we rely on our networks a bit more. We have to, you know, we have to be seen and available, and you sort of have to try and find ways to, you know, to try and find ways to route around the blockage. And I think that people are figuring those things out very quickly. And I think that, you know, any pause will only be a temporary one, because, you know, people just get on with things, and humans are very adaptable. So we find ways to make these sorts of things happen. And, you know, you might have fear of getting out of the house for a long time, but FOMO is going to take over pretty quickly. Once a deal or two starts to happen, then human nature starts to kick in and deals will happen.
Yeah. So just looking at the questions here, there's a question that's been upvoted. I don't know if you guys have seen it, about the lack of female representation on this panel, which I'm going to take entirely as Catherine's fault, not ours, for putting this together. But I think not wanting to make light of the issue. I mean, clearly, you know, I think it's widely known that male founders raise more capital, and you know, I guess finance as an industry is very male dominated. Is anyone able to offer some examples of something that your organizations are doing to try and sort of address this imbalance and try and sort of get more female representation, either in terms of on the boards that you have, or the companies you invest in, or how you operate? Does anyone want to go first on that? James, perhaps?
I can say that three of my female colleagues are doing a female founders fundraising event today. So look, we have female partners. We have obviously female associates within our company, and we invest into a lot of great companies. And I think that, you know, you need to get on the front foot very much with this sort of stuff. I think I take some, having organized a lot of events, I take some pity with Catherine in terms of trying to find speakers who can speak on a particular topic, and that is quite tough. But I think all you can really do is to make sure that you're identifying where the gaps are, and being very much on the front foot to try and answer those. Now, the thing that I just identified, which is how do you get those first conversations going in an environment where we're restricted from having our initial conversations. That's one of those sorts of things you identify. If you say, well, look, it is harder than it normally would be to make those first introductions. How can we try and overcompensate and be as available as possible? That's the sort of thing you need to identify. I don't have the answers for that just at the moment, but it is the sort of thing you go, okay, well, this could be a problem. How can we try and overcompensate for this? How can we make sure that we're out there? How can we make sure that we're not just tapping our existing networks of potential founders, and how can we make sure that we're as available as possible? That's the sort of thing you need to identify. Even if you don't have the answers, you just need to be aware that those things can be problems.
Yeah, I think that's a good answer. I mean, Nalin, not wanting to put you on the spot, is there any data that Pitchbook sort of, I guess it just validates that sort of view, does it?
Yeah, I mean, we've launched actually some female-centric and female-focused research as well, looking at the data underlying that. It's obviously is still heavily skewed towards males, but it is an area that's definitely gaining a lot of traction. And we're looking to add tools within our platform to try and identify companies that have female founders or people on the board or employees there, just because there has been an interest within investors and obviously in the broader general public of people wanting to identify and invest in companies that are promoting that. So it's definitely an area that we're kind of focusing a lot heavily on at the moment. And I think it's something that's going to continue over the next decade, really, in terms of like gaining traction in terms of VC generally, but also within the private capital markets, because it's not just a venture capital issue, it's private equity as well as the general financial ecosystem.
Yeah. Steve, did you have something? You look like you, or both of you, yeah, Steve, Jonno, yeah. Both.
I was just going to say, from our perspective, we've often run events that are sort of been female investor focused and also female founder focused as well. And just sort of noting that as a question, what people will never see is, as an event organizer, when you are organizing this sort of stuff, people will never see the rejections or the sort of non-responses that you don't get from people in trying to bring this together. But this is definitely for an area from our perspective that we want to be more proactive in and more encouraging, because really the way this space grows is by bringing more people into the mix and inspiring more people to actually join it, whether it be as a founder or whether to come in as an investor. So, that sort of, I said, while this is all male, I know that we'd all be doing our own activities and initiatives sort of outside of this that is championing that area.
Yeah, absolutely. Jonno, yeah.
I would just say, I mean, I've been at Virgin almost 10 years, and I've personally seen how our investment team has evolved from something that was very probably white male dominated when I arrived to it's almost 50% female at this point. We're in a team of 14 people. We've got 13 different languages and I think 12 nationalities. So it's pretty diverse, and we see the benefits of that. The conversation, the portfolio, the discussion around it has certainly benefited from that diversity. For specific initiatives, Virgin Startup came out last year. So Virgin Startup Loans, provides really early stage sort of, I guess, angel type funding to UK entrepreneurs, and they've made a commitment to provide 50% of that to female founders. So those are some examples of stuff that we're doing at Virgin, but we certainly see that we benefit from diversity across the organization.
Yeah, great. Thanks, John. I think we all recognise the importance of the issue. There's a question from Kim about social impact investing. And I know certainly from my experience at LendInvest over the last, probably since we started, but certainly increasingly over the last number of years, investors being really socially conscious and wanting to know what we're doing as a company to comply with things and what we're doing to sort of be good actors in the market. And there's a question specifically about healthcare innovation and whether that sort of plays into that thesis. James, do you want to have a
look?
What's your sort of view on social impact?
Yeah, look, one of the things to sort of pick up here. So obviously, like most VC funds, we have particular areas of focus. Fintech, deep tech, various others. But actually, healthcare is one of those areas. We've invested into companies like PushDoctor. PushDoctor, if you're sort of familiar with it, is sort of an online-only method of patients being able to speak to GPs. As you imagine, they've had a very busy time over the last couple of months here in the UK, and it's these sorts of services tend to make access to healthcare, sort of access to a service more widespread and more easily available. And I think I think sort of if you take a broad view of this, obviously healthcare is one aspect of this, but fintech is another. So, you know, financial access is one of the ways that people can actually move their lives forward, and make it easy to invest, make it easy to own a bank account, make it easy to transact. All these sorts of things make people's lives better by making their sort of these types of services more easy to access. And I think whether you look at, you know, personally, this is my personal belief, I think social impact comes from being able to deliver better services that make things easier for people to do. So, for example, we're an investor into an online trading company called Free Trade. They have, you know, they're a free to transact sort of web app-based you know, trading account, and that sort of makes the idea of trading online a much more accessible thing to do. I've looked at the platform, and I use the platform regularly, and I compare that to other systems out there which seem to be deliberately obscure, because I think that makes it harder to, it sort of keeps people out of online trading. And I think personally, I think public trading in public markets is a great way to build personal wealth. So, you know, we do some things in terms of investing in particular areas, whether we push Doctor or Free Trade, but also the general thesis about that is it makes it easier for people to access the sorts of services that bring quality to their lives.
Mm. And Steve, from Wholesale Investors' perspective, in terms of your network, do investors sort of factor the social impact nature of the company that they're looking to invest in? Is that kind of part of their thesis or criteria in your experience?
I was going to say, from what we've seen at our live events, when we've done panel sessions specifically, whether it be on social impact or just impact investment as an area, they're typically some of the most sort of you know, sort of sought after sessions. So yes, we are, and I think just the general nature of sort of investing at the moment is it sort of is looking for what is the thematic that's driving it, and also what is the impact that is going to have. So the investment, obviously, like renewable energy as an area. Is obviously come on quite strong for us over the last sort of couple of years, whereas previously before that, it sort of hadn't had that much time in the spotlight. Healthcare innovation is always strong in Australia. Like it's whenever we do our surveys, like it is literally always 1 and 2. And Australia is obviously known for investing a lot of money into life science, but now that sort of goes into spreads between life science, medical device, and obviously health tech as an area. So I would say, yes, that is part of it, simply because it's also easier businesses to commercialize, and typically those businesses also have a global appeal to them as well.
Jonno, do you have anything to add to that from investors' perspective?
Those are important sectors for us. I mean, we've got roughly 1/3 of our direct investment and of our fund investments in healthcare. So, you know, companies like Capsule and Doctor on Demand, which we've been invested in for many years. We've also got a fairly large portion, which we get through some of our fund relationships, in life sciences. And the reason we do that is, you know, these are the drugs and sort of cures for some of the world's biggest unmet needs that are typically sort of billion person type problems. You know, whether that's brain and metabolic disorders, cancers, etc. And obviously accentuated by COVID. So that's an important part, and we think that life sciences and biotech is an important sector. We don't do that directly just because we don't have the expertise, or we don't think we have that in-house to do that, but that's a very important allocation for us. And then renewables, one of the largest positions in our portfolio that I did back in 2015, and we've continued to invest, is a company called Generate Capital, which are essentially the leading platform in the renewable space. They do financing for proven renewable technology. They actually just landed a almost $1 billion round with the Queensland Investment
QIC.
Led the round in that. So to us, it's very important. But everyone seems to have jumped on the purpose bandwagon the last few years, and I'm proud to say that you can go back and read Richard's biographies that were written when I was still in high school in the 90s, and he's always, to us, that really is how they're treating their people and the communities. I think if you start and get those right, that they operate within, I I think there are lots of examples around the Virgin company of the impact that they have in the communities and what do you give back to the community. So I think that's where the social impact element comes in. You treat your people right and the communities right, then they'll be happy with the products, and your shareholders will be happy if people are happy with the products. That's always sort of been our focus, on people first, and the profit will sort of take care of itself. If you're doing a good job of that, you develop a loyal customer. People obviously package that in different ways, but that's how we judge the social impact of what we're doing. Is there clearly defined purpose within each of our companies, and are they treating the employees correctly? And then that just sort of trickles outwards from there. But to answer the question, we have some very direct exposure to healthcare, life sciences, and renewables within our portfolio. But I agree with the financial inclusion aspect of it as well that James spoke about. I would put most of our fintech investments in some way, whether it's remittance. Remittance last year, the FT came out with an article, is greater than foreign direct investment into Africa. This was last year. And so a company like TransferWise, which is making that easier and cheaper and faster and more convenient for people, that's having a massive impact on some place, I'm from Africa. So, the impact that has, I think, shouldn't be underestimated as some shiny fintech investment. This is real money it's saving people. That is the livelihood of so many.
I mean, it's one of those sort of underappreciated things, being unbanked and being able to access financial institutions, being able to unable to borrow money. All these sorts of things have huge restrictions on people's lives, and a lot of the very basic things that fintech is able to do is just to make those sorts of things available to people who wouldn't otherwise be able to do that. And that has huge impacts on people's lives. I get very messianic about the importance of financial openness.
We'll push pause on you there, James. To try and sort of try and get through as many questions, I guess, as we can. We're conscious that we're getting short on time. Are there any particular sectors that are exciting you as investors outside of the social impact side of things? And maybe Nalin, is there any sort of sectors that you see that are sort of getting increased interest or investment in recent times? And then for the investors on the panel, I guess it'd be just interesting, just very quick comment on sort of the size investments you typically target and stage. But maybe Nalin, start with you in terms of the excitement of different sectors.
Yeah, I think that the panel have kind of touched on it pretty interestingly already. I think healthcare is a very interesting sector at the moment, obviously considering COVID-19, not just in terms of telemedicine, which people have seen huge spikes in usage of online GP services, but also on the supply side, logistics and resource management kind of front. I don't think a lot of people would have thought hospitals would be running low on oxygen levels and PPE equipment. I think a lot of investment and attention will be turned towards those areas on the back end of healthcare infrastructure systems, especially ones that have been, world-class across the world for a number of years. And a lot of people are trying to, take advantage of kind of a first mover advantage there and trying to see what they can kind of do to make that a much more efficient process. Considering we can order something online and it can be delivered to us the next day, why is it taking hospitals quite considerably longer to kind of get stuff from stockpiles into the correct place? So that's an interesting area. Software as well, fintech that we've spoken about, that's been a huge investment area within the UK. London is probably the fintech capital of the world, and we've seen increased usage of online services now. People are just being pushed to use online services because banks just aren't open. And I think that's going to demonstrate a lot of stickiness in the long run. I know my parents don't really use online banking at all, but they've been forced to use it because banks are just simply not open. High streets are just not open at the moment. I think that's happening across the world. Cybersecurity is a huge area where I think online life may adjust because of this. And it's an exciting area because new attempts and new threats are always being created in how companies develop their AI and ML kind of learning tools to establish dominance against cyber criminals is a really interesting area. And then in terms of a kind of another different area, which we've seen a lot of interest in, is mobility. So the way people move around the world is potentially going to change. We've seen a few large deals take place in Europe for German startups that have involved robo-taxis, so Lilium and Volocopter. And these are basically light electronic vehicle aircrafts, basically, that can fly around cities in urban environments. And that is just something, yeah, exactly. That is something you'd see in a film from 20 years ago. And if something like that could come to market in 10 years with all the health and safety, logistical issues, the regulatory problems as well, or challenges, shall we say, if that can be something that is of the future, that is safe for people to use and cost effective, then I think those are some really interesting concepts that we could see gain some significant traction.
It's an exciting world. Steve, what excites you in your investor base, and what sort of size investment you guys looking at?
I was going to say, I can't really say much, pretty much in the same line as what Nalin just said, as far as sectors of interest, like it's right in alignment with that. I would add AI sort of related businesses as well to that list. From the size of deals, I think Australia is quite different to the UK in the typical size. Like most of the stuff we're seeing is still in the range of sort of that sort of 2 to 10 million, where I think in the UK, the size will typically be larger than that. I think you guys might be surprised to know is there's actually been IPOs getting away in Australia, and they've been sort of healthcare related, like sort of Atomo Diagnostic was a good example of that. And there's other healthcare and life science deals that are lining up to potentially list on the ASX, which is sort of counter to what you were saying before. So yeah, they're the sort of areas that are exciting us at the moment, and just once again, just reaffirming that the renewable energy as an area.
James, how about you?
So, not an investor myself. I sit on the sort of the platform side of that business, but no, I know that our investment.
You can't get out of the question.
No, I can't. No, I wouldn't want to. No, basically, we have fintech, we have deep tech, we have healthcare, we have consumer, and we have SaaS and B2B. Are the main sort of 5 pillars of the investment areas that we look at.
And size of investments?
So size of investments, the first check we write in a company. So if we're investing you the first time, typically it's going to be Series A. So at least sort of 5 to 10 million US. We don't tend to go earlier, but as I say, we have fund-to-fund investments into more than a dozen really top seed investment companies across Europe. So the likes of Seedcamp or Early Bird or various others. So if you are earlier than that and you're interested in speaking to investors, we can make referrals. But look, honestly, the sorts of companies that we invest in, they're able to hunt out the good quality deals anyway. But we tend to do that sort of Series A and beyond.
Great. And finally, Jonno, how about you guys?
Yeah, we typically invest between 1 and 5 million initial check, Series A through C. The round doesn't really mean anything to us more than we want to be able to use a product and interact with it ourselves and see some data about how users are engaging with us. We will invest, where something raises multiple rounds up to $15 million probably in a single company, which we've done historically. On this, I don't see any change in where we would focus necessarily, given following COVID. I think the last 10 years of sort of VC investing, the big companies that have been built have been in media and commerce. And I think we've still got a long way to go in terms of technology or software's impact on financial services, healthcare, and B2B. And I'm pretty excited about Europe being well placed in those sectors, or should I say not as far behind in those as it perhaps was in media and commerce. So I'd continue to look for opportunities in those sectors. And I think COVID, probably just is a tailwind to a lot of those.
And I think also just in terms of fintech, it's easy to get caught up on the big consumer fintech companies, but some of the most interesting fintech is the plumbing and infrastructure underneath, whether they be banks or insurance companies or capital markets or whatever else. So, that very sort of thing that Nalin identified, which is, your traditional bank isn't as competitive with a lot of fintechs at the moment. So there's a lot of technology being developed to help them to become more competitive against more nimble sort of smaller companies.
Yeah, totally agree. Unfortunately, we're out of time. There's a lot of great questions coming through, like really good questions. Next one I would love to have got to, but I guess a big thank you to the panelists and for offering your perspectives on things. I'm sure everyone's found it interesting and are set to enjoy a day of Zoom calls ahead, or if you're in Australia, probably finishing your day of Zoom calls or getting close. And with that, I'd like to just hand back to Catherine, I think, to say a couple of short closing remarks.
Well, thank you so much, Christian, and to all of our speakers, to Steve, Jonno, James, and Nalin for contributing to this session. You're a set of speakers that are obviously living and breathing the venture investment world, and it really showed in the breadth and acumen of territory covered. As Christian said, there were lots of questions coming through, including at the end, which we would have loved to get through. So hopefully we can have you all back in the near future to pick up on some of those and other themes. Thank you again to our partners, Wholesale Investor and Wago, for their support, and to the Chamber team, as always, for ensuring that things run without a hitch. And of course, all of our guests for logging in today. We've recorded this webinar and we'll be releasing it soon for you to rewatch or share with your colleagues. So look out for that in your inbox. We have a number of other webinars coming up this month, including on digital transformation and how it's being accelerated by COVID, the future of flying, particularly between Australia and the UK. That's a really hot topic at the moment. And our next D&I event, which will be focused on how we drive 50-50 outcomes for women and men in the workplace and at home. And on that note, and as we discussed in our panel today, we are really conscious that while we had some brilliant speakers today, we would have loved to have had some women represented. As Steve alludes to, we did reach out to some potential female speakers on this front, and indeed our original lineup, which was a pre-COVID lineup for this event, we were going to run it in March, we had 3 female speakers confirmed and lined up for. And indeed we've approached a number of women over the last few months, but the feedback that we've gotten is that it's really challenging for women to take on additional commitments at this time when many women are contending with significant work and childcare responsibilities. And the data that we have to date shows that COVID-19 has affected women disproportionately, and there's often a higher logistical threshold for them to take on those additional commitments. So this is a really deeply structural challenge which has been exacerbated by COVID-19, and it's something that we'll be talking about at our next D&I Chamber event on the 23rd of June. And in the context of this series, we'd also love to improve on our speaker mix. So I'd love to ask each of you watching, as well as our panelists, for your help and use of your networks in diversifying our panels in the future, particularly in the venture investment space, which, as Nalin says, is disproportionately male. Please let us know any great female investors and founders involved in the VC scene who you think would be great speakers with us and interested in taking part in the series. We'd love to hear from you on that. On that note, thank you again for being with us today. We'll see you soon and wish you a safe, positive week ahead. Thanks a lot.